Press the bell icon on YouTube and don't miss another update.
Hello, welcome to a new episode of Economics. Foreign sovereign borrowing is back in the news, and suddenly not for all the good reasons. Over the last week or so, there has been a lot of debate about this move by the Modi government, which was announced in the budget. Sections of the BJP and the Sangh Parivar are apparently not happy that India wants to borrow in dollar bonds. The government also seems to be a little confused. Subhash Chandra Garg, the finance secretary, was moved out, and one of the reasons that is being attributed for this shift is that he was the author or the man behind the idea for foreign dollar bonds. And then there is confusion among investors abroad. Will India go through with these bonds? The borrowing was supposed to have started in October. The amount was around just about $10 billion. So what is this big fear about borrowing in dollars abroad? To explain this, we have Professor Ila Patnaik, our contributing columnist, and professor at NIPFP. Ila, you wrote about borrowing abroad in dollars, and what India needs to do to get good terms on these borrowings, and how they can help the liquidity crunch in India. Now, suddenly, in the last week, 10 days, there seems to be some controversy, fear. What is the fear? I mean, why should India be afraid of borrowing $10 billion abroad?
Let's just go back to the question of why people are afraid of dollar borrowing. So, dollar borrowing means I take a loan from you in dollars, I commit to pay interest in dollars, and then the principal again in dollars. And that means that if the exchange rate moves in the interim, I have to bear the loss, because in rupee terms, just imagine that when I borrowed, the rupee was 50, I borrowed much less, and let's say it moves to 60 when I have to return the loan. So the borrower in such situations has the risk of a gain or a loss depending on which way the exchange rate moves. So that's really the exchange rate exposure, as we economists like to call it, or the currency risk that the borrower holds. Now, a lot of people are afraid that this may be that the rupee may depreciate a lot, and therefore you may have to pay back a lot. Others are afraid that because interest rates in dollars is low, and we'll kind of taste blood, government will forget to stick to its fiscal targets because it's got cheap borrowing, and then when suppose money starts flowing in, we could have high inflation, and we would really be setting ourselves up for a macroeconomic crisis if we were to start borrowing. The origin of all this goes back to Latin America and countries that did borrow a lot in dollars when debt was cheaply available. Now, the argument I am making here in my column is that, while of course there are risks for everything, I mean, just walking down the road is a risk today. There are risks, but we manage risks. And if the government is going to stick to its fiscal target, so we can always debate about off-budget borrowings, and we can debate about the quality of data, and that of course needs to get better. But let's say we're talking about the long term, when we are and have addressed these issues, then if the government sticks to its fiscal target, the FRBM, the Fiscal Responsibility and Management Act, and if the government and if the Reserve Bank sticks to its inflation target, which is 4 plus minus 2%, then really you're not looking at a large scale depreciation of the rupee. So that's where while some people may be scared looking at history, but if we look at today's situation, and if we believe that the government means well when it says that these two are the mandates, fiscal responsibility and inflation targeting, and along with that we set up mechanisms for making sure that the debt doesn't become all dollar debt and so on. We set up a public debt management agency. Then I think we manage those risks, and then we can go ahead with borrowing.
You also talk about how this is not the first time India will be borrowing in dollars abroad. India has done that before. What has that experience been like? Has there been any, thing that India did wrong the last time, or any fear of something going wrong like it did the last time?
So the times when we've borrowed are the Resurgent India bonds, the Millennium India bonds. So they were times when there was need for dollar flows. We've also borrowed from NRI, FCNRB deposits, they're called. So NRI deposits, dollar denominated deposits. Now usually we've given very high dollar returns on that. So I think the move now is that it's not as if we have a crisis today. So it's not that we have to turn to NRIs and say be patriotic and lend us money or at cheap rates or at high rates or whatever. Things are normal, pretty much normal. We are testing waters with a very, very small amount, and I think that there is a lot of appetite. There will be appetite for Indian paper, for Government of India bonds, and so you will get very good rates compared to last time. Now that's one thing. One more thing is, as you said, did something go wrong? Is it that the government started saying, oh, now that we can borrow abroad, we can borrow as much as we like? No, we didn't. We didn't. We've been sensible. In fact, India has not borrowed too much abroad. India has never defaulted on her debt. When inflation rises, let's say it started rising in the 90s about 7-8%, the Reserve Bank, even when it did not have an inflation targeting framework, the Reserve Bank steps in and takes anti-inflationary measures. Now we've gone even further than that, and we've put in place an inflation targeting law, given RBI a mandate. So I think broadly, in terms of macro stability, India has not been a country that has taken big risks, that governments have brought in an FRBM Act, have more or less, with a little bit of cheating, but have more or less tried to stick to it.
There is this worry about the rupee, and you talk about that in your latest column, that how the rupee could possibly move forward, appreciate or depreciate, and that could obviously, that will have an impact on your interest payments and your dollar returns. Do you think the government is worried about how the rupee may progress in the coming months? We know what's happening with the economy, our exports, the slowdown and all of that. So, and the fact that the government is also borrowing more than what the real fiscal deficit numbers tell us. So you think the government is a little worried about the direction of the rupee, which is why it is in turn worried about borrowing in dollars?
That's not the sense one gets, because if the government were to worry about the rupee, then the first thing it has to do is to contract its borrowing. Because it's like, if I consume more than I earn, then I'm really borrowing. Okay, so at the scale of an economy, a fiscal deficit spills over onto a current account deficit, which is why, think back of the IMF programs. When there was a rupee crisis or any currency crisis, what was the typical IMF advice? Cut your fiscal deficits. Okay, so they do that everywhere, because that's basic macro, that if you are worried about the currency, then you contain demand or domestic demand in the economy. See, at the moment, yes, I agree, there's a export slowdown. It's, it's global conditions. But we're seeing an import slowdown. So it's not just that, and in fact, the adjustment has been that the trade account or the CAD has not expanded, because your imports have also slowed down, because the domestic economy has not been rising that fast and has not been importing as much. So to answer your question, I don't have the sense that this borrowing of $10 billion or the sovereign borrowing is because there is a sense that the rupee may depreciate. I think it's more of something that we are just testing waters and seeing. We should have Indian government sovereign bonds. When there is a need, yes, this will be useful to be able to borrow more.
And you talk about the reforms that are needed to actually make this successful. And before that, I mean, the point I also was, remembering is, India has $400 billion plus worth of forex reserves. So what is, 10?
That's why I'm saying there's hardly any risk. It's very, 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 very small. So when you have more than $400 billion of reserves, then 10 billion is a very, very small risk. I think people also, I think everybody understands that today the risk is not much. What people like, say, Rathin or some of the others are concerned about, and their concern is genuine, is that if we don't stick to fiscal targets, if we don't do inflation targeting properly, or if it doesn't work because the transmission mechanism is bad, if we don't have a public debt management agency that says, okay, only X% of government debt should be in dollars, otherwise the risk is too much, which really means that if we turn into a government that wants to take a lot of risk, borrow a lot, looks at cheap money and then just forgets that there's a future to take care of, under those circumstances, this would be a risky strategy. So they're alluding to risks which might come if we behave irresponsibly. So, in addition to all the other problems that not having an inflation target and high fiscal deficit will cause, this external debt will be another burden on our heads. So that's the risk they're worried about.
So it's like saying if you drive badly, you'll meet with an accident, but so don't drive badly.
So what I'm saying is, don't stop driving.
Don't stop driving.
Don't stop driving.
That's even better.
Don't stop driving. Drive. Be careful. Stick to the rules of the traffic rules.
So you talk about transparency, transmission, and public debt management agency are the three big reforms to focus on to help this overall macro framework. But what is your sense? I mean, since October was the time when they were planning to do a roadshow to get some investments, do you think that will go through, or there may be delays, or there's still some kind of negotiating going on within the government?
See, you read the papers as much as I do. I have no internal knowledge. I just think
your sense. What is your sense?
My sense is that if the government is truly committed to FRBM and inflation targeting, and is going to go ahead with setting up a bond market and a debt manager, which is part of the plans, then it should go ahead with this, because then it will make it clear that, look, we are not scared that foreign investors are watching what we are doing. You know what this does, and I think it's a very good commitment device actually, is to say we are doing 10 billion, okay, but that means everybody around the world is watching us. We will give you more fiscal transparency, we will give you fiscal consolidation, because if they don't, then you have everybody hitting you. Your rating is going to go bad. Things are going to go much worse if you're going to behave badly after having done this. So it's a good commitment device. You should go ahead and do this. It will show the government's good intentions if it goes ahead and does this.
So India actually stands to gain, as you say.
It stands to gain not just because of the cheap money. It stands to gain because the government has to be more committed to the FRBM targets, to inflation targets, and to managing its debt well.
Thank you, Reela. We will know in a couple of weeks whether the Modi government goes through with its borrowing in dollars abroad or not. Please keep watching Economics, and we will be back with a fresh episode next week. Thank you.